Good
Good
day,
day,
everyone.
everyone.
I am Leslie J. Silakan.
I am Colonel G. Sumalpong.
I am Jerry Emmanuel Tizon.
And I am Princess Cariel V. Zerna.
We are the Group 7.
And we are going to discuss the Chapter 11 and Chapter 12.
Chapter 11 Enterprise Resource Planning Systems will be discussed by Jerry and Colonel.
Chapter 12 Business Ethics, Fraud, and Fraud Detection will be discussed by Princess Cariel and Leslie Joy.
Let's begin.
Chapter 11 Enterprise Resource Planning Systems. Hi, I am Jerry Emmanuel Tizon, and I will be discussing half of the topics in this chapter. What is an ERP? ERP systems are multiple module software packages that evolved primarily from traditional manufacturing resource planning systems. The Gartner Group coined the term ERP, which has become widely used in recent years. ERP systems support a smooth and seamless flow of information across the organization by providing a standardized environment for a firm's business processes and a common operational database that supports communication. The objective of ERP is to integrate key processes of the organization such as order entry, manufacturing, procurement, accounts payable, payroll, and human resources. ERP core applications. ERP functionality falls into two general groups of applications. First is the core applications. Core applications are those applications that operationally support the day-to-day activities of the business. If these applications fail, so does the business. Second, business analysis applications. Business analysis applications are those applications used to work as a liaison among stakeholders in order to understand the structure, policies, and operations of an organization. Next is the online analytical processing, or the OLAP. It includes decision support, modeling, information retrieval, ad hoc reporting or analysis, and what-if analysis. Some ERP support these with their own industry-specific modules that can be added to the core system. Next is the data warehouse. Data warehouse is a database constructed for quick searching, retrieval, ad hoc queries, and ease of use. The data are normally extracted periodically from an operational database or from a public information service. Next is the ERP system configurations. Server configurations. The servers may be centralized, but the clients are usually located at multiple locations throughout the enterprise. There are two basic architectures in this. First is the two-tier model. In a typical two-tier model, the server handles both applications and database duties. Client computers are responsible for presenting data to the user and passing user input back to the server. Some ERP vendors use this approach for local area network or LAN applications for which the demand on the server is restricted to a relatively small population of users. Second is a three-tier model. In the three-tier model, the database and application functions are separated. This architecture is typically of large ERP systems that use wide area networks or WANs for connectivity among the users. Satisfying client request requires two or more network connections. Initially, the client establishes communications with the application server, and then the application server then initiates a second connection to the database server. Next is OLTP versus OLAP. OLTP and OLAP have specialized requirements that are in direct conflict. OLAP applications support management critical tasks through analytical investigation of complex data associated that are captured in data warehouses. Next, OLTP applications. It supports mission-critical tasks through simple queries of operational database. Next is the supply chain management. Another development regarding the bolt-on software issue is the rapid convergence between ERP and bolt-on software functionality. Supply chain management software is a case in point. The supply chain is the set of activities associated with movement goods from the raw materials stage to customer. This includes procurement, production scheduling, order processing, inventory management, transportation, warehousing, customer service, and forecasting the demand for goods. Next is the data warehousing. Data warehousing is one of the fastest growing IT issues for business today. Not surprisingly, data warehousing functionality is being incorporated into all leading ERP systems. A data warehouse is a relational or multidimensional database that may consume hundreds of gigabytes or even terabytes of disk storage. When the data warehouse is organized for a single department or function, it is often called a data mart. Rather than containing hundreds of gigabytes of data for the entire enterprise, a data mart may have only tens of gigabytes of data. The data warehousing processes has the following essential stages. First, modeling data for the data warehouse. Second, extracting data from operational databases. Third, cleansing extracted data. Fourth, transforming data into the warehouse model. Fifth, loading the data into the data warehouse database. First, modeling data for the data warehouse. Normalizing data in an operational database is necessary to efficiently and accurately reflect the dynamic interactions among entities. Data attributes are constantly updated, new attributes are added, and obsolete attributes are deleted. Extracting data from operational databases. Data extraction is a process of collecting data from operational databases, flat files, archives, and external data sources. Operational databases typically need to be out of service when data extraction occurs to avoid data inconsistencies. Next is the cleansing extracted data. Data cleansing involves filtering out or repair invalid data prior to being stored in a warehouse. Operational data are dirty for many reasons. Clerical data entry and computer program errors can create illogical data such as negative inventory quantities, misspelled names, and blank fields. Data cleansing also involves transforming data into standard business terms with standard data values. Next is the transforming data into the warehouse model. A data warehouse is composed of both detailed and summary data. To improve efficiency, data can be transformed into summary views before they are loaded into the warehouse. Next is the loading the data into the data warehouse database. Most organizations have found that data warehousing success requires that the data warehouse be created and maintained separately from the operational databases. That's all for my part. The other half of the topics will now be discussed by Colonel Neil.
Hello, I am Colonel G. Sumalpong and I will discuss the continuation of the topic for this chapter. So let's proceed to the risk associated with ERP implementation. This section examines some of the risk issues that need to be considered. These are the list of risks and I'll tackle it one by one. First is the Big Bang versus phased-in implementation. Big Bang method is used to describe a go-live scenario where a business switches from its existing ERP system to a new solution at a single point in time. In contrast, phased-in approach describes a scenario where elements or modules of the ERP system are introduced in a planned sequence, replacing the old system gradually. So why are those risky? For Big Bang approach, if something goes wrong in one area, it could create problems for your entire ERP implementation. In addition, It would also lead to temporary lack of productivity across the company as your staff scrambles to remember the training they received over prior months and may tend to fall back into old habits. For phased-in approach, the longer timelines in a phased rollout will lead to higher implementation and consulting costs as well as a delay in your return on investment cycle. Plus, you may need to allocate additional budget to the development of interface tools. Next is the opposition to changes in the business culture. The firm's willingness and ability to undertake a change of the magnitude of an ERP implementation is an important consideration. The technological culture must also be assessed. Organizations that lack technical support staff for the new system or have a user base that is unfamiliar with computer technology face a steeper learning curve and potential greater barrier to acceptance of the system by its employees. The third one is choosing the wrong ERP. A common reason for system failure is when the ERP does not support one or more important business processes. In this case, number of issues need to be considered. First is the goodness of fit. Management needs to make sure that the ERP they choose is right for the company. Second is the system scalability issues, in which it is the system's ability to grow smoothly and economically as user requirements increase. Next is choosing the wrong consultant. All ERP implementations involve an outside consulting firm which coordinates a project, helps the organization to identify its needs, develops a requirement specification for the ERP, selects the ERP package, and manages the cutover. A frequent complaint is that consulting firms promise experienced professionals but deliver incompetent trainees. They introduce their top consultant who are sophisticated, talented, and persuasive. The client agrees to deal with the firm but incorrectly assumes that this individual will actually implement the system. Next is high cost and cost overruns. Total cost of ownership for ERP systems varies greatly from company to company. TCO includes hardware, software, consulting, services, internal personnel costs, installation, and upgrades and maintenance to the system for the first 2 years after the implementation. The risk comes in the form of underestimated and anticipated costs. Some of the more commonly experienced problems occur in training, system testing and integration, and database conversion. Hence, developed performance measures should be considered. To assess benefits, they should establish key performance measures such as reductions in inventory levels, inventory turnover, stock outs, and average order fulfillment time that reflect their expectations. Last is disruptions to operations. The re-engineering of business processes that often accompanies ERP implementation is the most commonly attributed cause of performance problems, as an adjustment period is needed for everyone to reach a comfortable point on the learning curve, and it may take longer in some firms. The list of major organizations that have experienced serious disruptions include Dell Computer, Apple Computer, Whirlpool Corporation, and Waste Management. The most notorious case was Hershey Foods Corporation, which had trouble processing orders through its new ERP system and was unable to ship products. As a result, Hershey's 1999 third quarter sales dropped by 12.4% and earnings dropped by 18.6%. Now let's move on to the implications for internal control and auditing. Key concerns are examined next within the COSO framework. These are the list of implications and I'll tackle it one by one also. First is the transaction authorization. A key benefit of an ERP system is tightly integrated architecture of modules. This structure, however, also poses potential problems for transaction authorization. Example, the bill of materials drive many manufacturing systems. If the procedures for the creation of the bill of materials are not configured correctly, every component that uses the bill of materials could be affected. Hence, controls need to be built into the system to validate transactions before other modules accept and act upon them. Second is the segregation of duties. Manual processes that normally require segregation of duties are therefore often eliminated in an ERP environment. ERP forces together many different business functions such as order entry, billing, and accounts payable under a single integrated system. Hence, organizations must establish new security, audit, and control tools to ensure duties are properly segregated. Third is the supervision. Too often, when ERP is up and running, only the implementation team understands how it works. The employee-empowered philosophy of ERP should not eliminate supervision as an internal control. Instead, it should provide substantial efficiency benefits. Therefore, supervisors should have more time to manage the shop floor and through improved monitoring capability, increase their span of control. Next is the accounting records. Many organizations need to import data from legacy systems into their ERP systems. This data may be laden with problems such as duplicate records, inaccurate values, or incomplete fields. Hence, strict data cleansing is an important control to reduce this risk and ensure that the most accurate and current data are being received. The fifth one is the independent verification. Independent verification controls such as reconciling batch control numbers serve little purpose. Process reengineering to improve efficiency also changes the nature of independent verification. Therefore, the focus of independent verification needs to be redirected from the individual transaction level to one that views overall performance. The last one is the access controls. The goal of the ERP access control is to maintain data confidentiality, integrity, and availability. Security weaknesses can result in transaction errors, irregularities, data corruption, and financial statement misrepresentation. Also, uncontrolled access exposes organizations to cybercriminals who steal and subsequently sell critical data to competitors. Security administrators therefore need to control access, and they could use either traditional access control models and role-based access control. The traditional access control models, traditionally, the owner of a system resources grants access privileges individually to user based on the individual's trust level and job description. In contrast, role-based access control emphasizes that a role is a formal technique for grouping together users according to the system resources they need to perform their assigned task. Next is the internal control issues related to ERP roles. Although RBAC is an excellent mechanism for efficiently managing access control, the process of creating, modifying, and deleting roles is an internal control issue of concern for management and auditors alike. The key concerns are: first, the creation of unnecessary rules in which managers in an ERP environment have significant discretion in creating a new roles for individuals. Such access granting authority needs to be tempered with judgment to prevent number of roles from multiplying to the point of becoming dysfunctional and thus creating a control risk. Next is the role of least access. ERP users tend to accumulate unneeded permissions over time, and this is often due to two problems. First, managers fail to exercise adequate care in assigning permissions as part of their role granting authority. Second, managers tend to be better at issuing privileges than removing them. Third one is monitor role creation and permission granting activities. Verifying role compliance across all applications and users in an ERP environment poses a highly complex and technical problem. In that case, role-based governance systems are available for this purpose, which continually monitor risk and issue alerts when violations are detected and maintain an audit trail to provide record of violations and evidence of compliance. Let's move on to contingency planning, in which it is defined as a course of action designed to help an organization respond to an event that may or may not happen. The implementation of ERP creates an environment with a single point of failure, which places the organization at risk from equipment failure, sabotage, or natural disaster. To control this risk, an organization needs an effective contingency plan that can be invoked quickly in the event of a disaster. It is extremely useful because by identifying potential problems, you'll be able to take action to prevent them from happening. So, that's all for this chapter. Hope you understand. Thank you.
Chapter 12 Business Ethics, Fraud, and Fraud Detection. Hi, I am Princess and I am assigned to discuss about ethics in a business. The objective for my discussion is to heighten the reader's awareness of ethical concerns relating to business, information system, and computer technology. Ethics means the moral principle of an individual which governs a person's behavior and serves as their guide in making choices. It's a subjective understanding of right and wrong because we have our own individual societal mores and deep-rooted personal beliefs. Ethics can be applied in our everyday life or even in our job. Similarly, it can apply in business, which helps business workers make a decision. The ethics in business are those policies and practice regarding potentially controversial subjects, including corporate governance, insider trading, bribery, discrimination, corporate social responsibilities, and fiduciary responsibilities. There are ethical issues in business ethics. It is divided into 4 areas, such as the issues in equity, rights, honesty, and the exercise of the corporate power. Ethical issues in business in terms of equity, as you can see in the screen, is grounded by the principle of distributive justice. Since we can see that there are differences in salaries or the worth depends on how you contribute to the management, it can also be found in product pricing by making sure that the price of the product justifies its value. Ethical issues in terms of rights are those human rights as we have in our country, such as the right to respect so as to avoid any harassment or discrimination, or even in terms of unequal employment opportunities and many more. There's also an ethical issues in terms of honesty, which can affect even the whole business when honesty is not adhered upon. For example, is the honesty in terms of advertisement in order not to mislead the customers, or the honesty in providing financial reports to the investors. Lastly is the exercise of the corporate power, such as having to consider the workplace or the rules and regulations set by those in higher position, setting the best interest of the whole institution in mind. Computer ethics refers to the analysis of the nature and social impact of computer technology and the corresponding formulation and justification of policies for the ethical use of such technology. In layman's term, it's a moral standard which governs the use of computers, since there are a lot of ethical issues regarding computer crime, working conditions, privacy, and many more that emerge most especially in this continuous improvement of information technology. There are 3 levels of computer ethics, and each level is vital to the overall goal of protecting and advancing human values. Starting with a pop computer, which is simply the exposure to stories and reports found in a popular media regarding the good and bad ramifications of computer technology, since almost every day different news stories regarding computer virus or any software lawsuits and many more can be found, which promotes awareness to the users of technology. Next, paracomputer involves taking a real interest in computer ethics cases and acquiring some level of skills and knowledge in the field. It doesn't necessarily mean having a profound knowledge in this field, but somehow has a relevant special knowledge, such as by making a preliminary assessment and identification of computer ethics cases, compares them with others, and suggests possible analysis. Lastly is the theoretical computer ethics, which is of interest to multidisciplinary researchers who apply the theories of philosophy, sociology, and psychology to computer science with the goal of bringing some new understanding to the field. There are several issues of concern for students of accounting information system. These are the concern in terms of privacy, security, ownership of property, equity and access, environmental issues, artificial intelligence, unemployment and displacement, and misuse of computer. These are basically an issue of protection now that we are engaging almost every day in social media, and even class modules and activities are uploaded online. Even workers are being reduced due to technology advancement and so forth. Sarbanes-Oxley Act is the most significant securities law, and this includes addressing ethical issues. As such, a public company may disclose its code of ethics, either an exhibition to its annual report, posting to its website, or by agreeing to provide copies of the code upon request. The Securities and Exchange Commission has ruled that compliance with Section 406 necessitates a written code of ethics that address the following ethical issues, such as conflict of interest, full and fair disclosure, legal compliance, internal reporting of code violations, and accountability. By addressing the following, it can prevent users of information technology to violate the rules, as there are rules and regulations written that should be fully and faithfully complied with. That's all for my part. The other half of the topics will be discussed by Leslie.
Hi, I'm Leslie J. Silakan, and I will be discussing the continuation of the topics for this chapter. Perhaps no major aspect of the independent auditor's role has caused more controversy than the responsibility for detecting fraud during an audit. Fraud denotes a false representation of a material fact made by one party to another party with the intent to deceive and induce the other party to justifiably rely on the fact to his or her detriment. According to common law, a fraudulent act must meet these 5 conditions: false representation, material fact, intent, justifiable reliance, injury, or loss. Auditors encounter fraud at 2 levels. Employee fraud is generally designed to directly convert cash or other assets to the employee's personal benefit. Management fraud often escapes detection until the organization has suffered irreparable damage or loss. The fraud triangle consists of three factors that contribute to or are associated with management and employee fraud. These are situational pressure, which includes personal or job-related stresses that could coerce an individual to act dishonestly. Opportunity, which involves direct access to assets and/or access to information that control assets. And ethics, which pertains to one's character and degree of moral opposition to acts of dishonesty. The actual cost of fraud is difficult to quantify for a number of reasons. Not all fraud are detected, not all are reported, incomplete information is gathered, information is not properly distributed to management or law enforcement authorities, and business organizations decide to take no civil or criminal action against the perpetrators of fraud. The Association of Certified Fraud Examiners study examined a number of factors that profile the perpetrators of the fraud. It may be within the organization, the collusion effect, by gender, by age, and by education. There are three broad categories of fraud schemes. Fraudulent statements are associated with management fraud, where the statement itself must bring direct or indirect financial benefit to the perpetrator. It is not simply a vehicle of obscuring or covering a fraudulent act. Corruption. The ACFE study identifies four principal types of corruption. Bribery involves giving, offering, soliciting, or receiving things of value to influence an official in the performance of his or her lawful duties. An illegal gratuity involves giving, receiving, offering, or soliciting something of value because of an official act that has been taken. A conflict of interest occurs when an employee acts on behalf of a third party during the discharge of his or her duties or has self-interest in the activity being performed. Economic extortion is the use of force by an individual or organization to obtain something of value. Asset misappropriation is the most common fraud schemes in which assets are either directly or indirectly diverted to the perpetrator's benefit. SAS 99, Consideration of Fraud in a Financial Statement Audit, has list that demonstrates how the external auditor must now think about fraud during every phase of the audit processes and how to assess the risk factors related to both fraudulent financial reporting and the misappropriation of assets. Fraudulent financial reporting. External auditors should look for the following kinds of common schemes: improper revenue recognition, improper treatment of sales, improper asset valuation, improper deferral of costs and expenses, improper recording of liabilities, inadequate disclosures. Misappropriation of assets. Common schemes include personal purchases, ghost employees, fictitious expenses, altered payee, pass-through vendors, theft of cash or inventory, and lapping. The auditor's judgments about the risk of material misstatements due to fraud may affect the audit through engagement, staffing, and extent of supervision. The knowledge, skill, and ability of personnel assigned to the engagement should commensurate with the assessment of the level of risk of the engagement. Professional skepticism. Exercising professional skepticism involves maintaining an attitude that includes a questioning mind and critical assessment of audit evidence. Nature, timing, and extent of procedures performed. Fraud risk factors that have control implications may limit the auditor's ability to assess control risk below the maximum and thus reduce substantive testing. The auditor's response is thus influenced by the degree of assessed risk. In some cases, the auditor may determine that currently planned audit procedures are sufficient to respond to the risk factors. In some cases, the auditor may decide to extend the audit and modify planned procedures. In rare instances, the auditor may conclude the procedures cannot be sufficiently modified to address the risk, in which case the auditor must consider withdrawing from the engagement and communicating the results for withdrawal to the audit committee. The auditor should document in the working papers the criteria used for assessing the fraud risk factors. Identified risk factors and the auditor's response to them should be documented. Because of the need to falsify accounting records, many fraud schemes leave a trail in the underlying accounting data that the forensic auditor can follow if he or she knows what to look for. To find the trail in the masses of data, The auditor first develops a fraud profile that identifies the data characteristics that one would expect to find in a specific type of fraud scheme. Once the fraud profile is developed, ACL can be used to manipulate the organization's data to search for transactions that fit the profile. So that's all for this chapter. Hope you understand. Thank you.
So that's all for our presentation. We hope that you've enjoyed our discussions and gained knowledge about chapters 11 and 12. Thank you and have a great day, everyone.